With the Eurozone, finance ministers in the EU have told Portugal that it will have to implement new economic reforms to secure an EU-IMF bailout. Now, the European Union expects these measures to be more stringent than those proposed by the outgoing Portuguese government. The deal is expected to be sealed before the new government is elected on the 5th of June.
Few were surprised by Portugal's request for financial help from Europe, but for many the decision came sooner than expected. The country's caretaker Prime Minister José Sócrates had been trying to avoid seeking a bailout from the EU and IMF. His change of heart has divided the country.
I'm not sure it's good for everyone, but yes, I agree with the request. He should have done it a long time ago, even before the government fell.
Portuguese bank stocks rallied after the request, and it's thought a deal can be negotiated despite the political vacuum caused by the Prime Minister's decision to stand down last month. An election is set for June, but a deal is expected before then. We
don't really envisage a major obstacle. There is some political upheaval which has been well reported, well documented, but nonetheless I think that both parties and the President will come together with the EU and be able to get the deal done ASAP.
There was no sign of market turmoil after the announcement, and the euro barely moved. Many economists said Lisbon had been denying economic reality over the past few months. But while a bailout was expected, it offers no long-term solutions. It may help Lisbon's immediate financing problems, but Portugal will still have a double-digit deficit, a growth problem, and creditors to feed. And it'll have to agree to tough austerity targets in return for the loan. That could have a detrimental effect on an already stagnant economy. Like Greece and Ireland before it, Portugal, said one economist, has a hard road ahead. Sonia Legg, Reuters.
And the focus is now on Spain, but Madrid has vowed it will not need to seek a bailout.
Spain has vowed it will not be the next indebted Eurozone member to need a bailout, despite its economic links to neighbour Portugal. European officials have long expressed concerns that the economic woes of smaller members could spread to countries like Spain, which are too big to bail out.
The other, particularly the larger economies, Belgium, Spain and Italy, there's a clear distinction in the market, I think for some of the right reasons. And if you look at the market mechanics here, those markets are so large, one of the things that cannot happen in contrast to the smaller ones is that investors basically shun them altogether.
Traders in Madrid say for now the market seems satisfied with the country's economic reforms and don't see contagion yet.
I think the market rewards, in quotes, the measures taken by the Spanish government, and in that sense it has generated a certain climate of trust towards the Spanish economy, which is key right now.
The first signals for Spain after Portugal's call for aid were positive. Madrid comfortably sold over €4 billion of debt in Thursday's bond sale. But investors will be watching Spain closely over the coming months to make sure it maintains the pace of its spending cuts and reforms. Joanna Partridge, Reuters.